Good day and welcome to the Florida Chamber Foundation Economic Outlook webinar. As a reminder, today's conference is being recorded. At this time, I would like to turn the conference over to Doug Davidson. Please go ahead.
All right. Well, thank you very much, Ivy, and good morning to everybody. We're very, very grateful that you chose to spend part of your day with us with the Florida Chamber and the Florida Chamber Foundation. I think we have an excellent discussion and some great speakers lined up for you for this call. So I know that you'll find this time very well used. My name is Doug Davidson. I'm the Commercial Banking Market Executive with Bank of America, and I also have the pleasure of serving as the chair for the Florida Chamber Foundation. Many of you on the line know that we held a CFO roundtable last year. Our guest speaker was Florida Chief Financial Officer Jeff Atwater, and we had an incredible discussion to discuss the issues and the opportunities that are impacting your business. We had attendees ranging from small, young companies all the way up to large corporates that operate globally, and we came together to meet with other CFOs, with Jeff Atwater, to talk about things like taxes, infrastructure, regulation, capital. What are the key drivers to help make Florida a more competitive place? Because of that very positive feedback that we received from that meeting, we wanted to broaden the audience. And we're very pleased to have everyone with us today to hear an economic forecast about the state of Florida. You know, I will take a quick point to make a comment. I read a lot of economic data. My company, Bank of America, produces a lot of economic data. I try to read as much as I can daily from the Wall Street Journal. What I've found is that it can be challenging to find Florida-specific economic data. That's why I'm so grateful for the Florida Chamber and the Florida Chamber Foundation, for people like Dr. Jerry Parrish, who have a keen eye on economic data that's related to our state. In fact, today you'll hear from 3 experts who will give you a preview of some of the issues that will impact businesses and the state of Florida. Dr. Jerry Parrish is the Florida Chamber Foundation's chief economist, and he's the director of research. Dr. Parrish will provide an economic forecast for the state of Florida. You'll also hear about our nation's economic outlook from Dr. J.D. Foster. He is the Vice President in Economic Policy Division and Chief Economist for the United States Chamber of Commerce. I'm also very pleased to have with us today John Coates. He is a relationship manager with PNC Capital Advisors, and he's going to provide for us an international outlook related to these topics. So I want you to know that we're very grateful that you're spending part of your lunch with us today. And at this point, I'd like to turn it over to my good friend, Mark Wilson, President and CEO of the Florida Chamber of Commerce. Mark?
Well, Doug, thank you very much for that, and I want to thank you also for serving as the chairman of the Florida Chamber Foundation for 2017 and 18, and also on behalf of all of us on the call today, I want to thank you and Bank of America Merrill Lynch for supporting today as the sponsor of today's webinar. You made this possible, so thanks to all of our guests, local chambers of commerce, and others that are on the line today. Appreciate everybody spending time with us. So. Just quickly, I want to set this up for everyone because Florida is changing fast, and so we're finally past an election that seemed like it lasted for years, and now what we're finding in Florida is everyone is quickly putting that in the rearview mirror and quickly talking about 2017. What's going to happen in Florida? What does the economy look like? And as I said at our annual meeting last month, Florida is changing, and it's changing in big and profound ways. Our politics are changing, our demographics changing, our economics are changing, and that, in fact, is why we're doing this webinar today, to put the brightest minds that we could together to give us a sense of where Florida is going. And just to put Florida in perspective on a global stage, if you look at Florida's GDP, if we were our own country, if Florida was a nation, we would have the 16th largest economy in the world. That's a big deal. Florida's growing, and you're going to hear about that today. Also, as a framework, I wanted to spend a minute on the 6 pillars. So we've done over $1 million of research in the Florida Chamber Foundation, and as we look to Florida's future, we know that getting the 6 key pillars, the framework, everything from talent to health care, getting it right is actually going to be the key to continuing to grow and diversify Florida's economy. So, again, we're going to have 6 million more residents in Florida by 2030. We'll be at 26 million. We're going to have another 50 million annual visitors. And over that period of time, we need to create 2 million new jobs, again, between now and 2030. That's just to remain at the unemployment rate we're at right now. So keep that in mind as we go forward. So I mentioned Florida's changing. Just a quick word on the political changes in Florida. And I think, as everybody knows, politics and economics are closely related, because who is elected to run a state or a nation has a lot to do with how the economy might do, what the attitudes are of consumers, of business leaders, of investors, and so forth. And so just a quick look at Florida and how much we've changed in the last decade. 10 years ago, we had just over 10 million voters. Today, we're about 13 million voters. But what's significant here, and the connection to the economics, is if you look at the massive growth of these no-party affiliate voters, we've added about 1.2 million voters to this no-party affiliate category. And if you combine all of the new voters in the Republican Party and the Democratic Party and you put them together, it begins to equate to all the new voters in the no-party affiliate area. So Florida is unique in that regard, and I wanted to point that out right up front. Also, when you look at the way people are voting in Florida, people are voting by mail, or absentee, as some people call it. People are voting early, and that's having a big impact on everything from presidential elections to local elections in Florida. And as a matter of fact, I just want to point out, we're getting the research in on this now. If you look at the behavior of this most recent election that we had in November in Florida, you'll notice that about 2 weeks before the election, half of all of the voters in Florida that voted by mail or absentee had already voted. That's 2 weeks out. And if you look 1 week out from the election, we now know that over half of all the voters in Florida who voted had already voted a full week ahead of the election. Again, that's unique. That doesn't happen in many other places, and it's another example of how Florida is changing. Another part of our research department, our political research, we're always polling. In fact, we've conducted 40 voter polls since August of this year. It's important to us that we know how consumers and voters feel. And as you can tell, most people think Florida is headed in the right direction, 46% to 31% wrong direction. But if you look at the dichotomy, if you will, from certain parts of Florida, you know, if you're in Miami, you're not very optimistic about where Florida is headed. But if you're in other parts of Florida, you're quite optimistic. You know, men are more optimistic than women. Republicans are more optimistic than Democrats, and so we just need to pay attention to how consumers feel about Florida. It matters. In terms of the demographic changes, you know, if we look out to 2030, we know our research department lets us know with pretty good accuracy what we think our demographics are going to look like out to 2030. The significance of what you're looking at here is Florida is actually losing more than 200,000 people in what we would call the high spender category, if you will, in that 50 to 59 age bracket. We're also adding over 2 million Floridians in the over 65 category. This is neither good nor bad. I just share it with you because it's happening. We're looking closely at what it will do to state revenues. Our state budget in Florida relies on sales tax revenue to fund about 77% of our general revenue. About 93% of the population increase in Florida is going to come from outside Florida. So a lot of wealth moving into Florida, but there's going to be changes and stresses put on our tax structure for sure. And then finally, I mentioned that our economics are changing. I think it's important, you know, everywhere I go as president of the Florida Chamber, I make sure people know if Florida was a stock, I'd be buying as much of it as I could afford. Our fundamentals are strong. Our performance has been good. If you look at it, Florida creates 1 out of every 10 new jobs in the United States. We have almost 250,000 open jobs in Florida today. In fact, some people say we have an unemployment issue. The reality is in Florida, we have plenty of jobs. We have a skills gap challenge that we're working to fix. In terms of how diversified is Florida's economy, again, Dr. Parrish shared with me that if you look at Florida compared to all the other states, we're actually quite diverse. In fact, if you rank the states, we have the 22nd most diverse economy in America. Most people think we're about agriculture, tourism, and construction, and those are three incredibly important industries to Florida's future. They're our foundation in many ways. But we're diversifying, and we're diversifying rather quickly, and that bodes well for the long-term outlook for Florida. We've made major policy changes in manufacturing, innovation, research and development, and all of these policy changes appear to really be paying off. Our unemployment rate obviously below 5%, and it continues to be there. If you look within the state of Florida, not just how Florida compares to the rest of the country, if you look at all 22 metropolitan statistical areas, we can look that the Orlando area is the most diversified economy in Florida. And then if you go up the road a little bit to Gainesville, you notice that the Gainesville MSA is the least diversified economy in Florida. So, again, I'm not saying these are good or bad, but these are incredible opportunities and strengths. If you look in Central Florida, for example, most people don't know that our defense industry, our modeling and simulation industry, the financial services industries, these are growing. These are incredibly strong. Companies are relocating to Central Florida because of what's going on there. So, and then finally, I want to just a few words on what Florida is doing to measure our progress. Think about vital signs, if you will. What we have here is we've had a request from our members of the chamber, from policymakers, from media, from local chambers, from economic development groups. If I were to ask anybody on the call today, how's your company doing? How are you doing today compared to a year ago? Everybody on the call could give me concrete answers with clarity. But if I were to ask you how Florida is doing, all of a sudden we realize that Florida hasn't always had a way to tell. So our research team in the Florida Chamber Foundation created the FloridaScorecard.org. And it's free for you, for your employees, for the media, for policymakers. And we're measuring hundreds of vital signs. And we're not going to take the time to go through this today, but as you can see on the screen, you can see the unemployment rate. You can see that we've created 253,000 jobs year over year. You can look at sales tax revenues. You can look at, see that 805,000 number in the middle? Every day, 24 hours a day, 365 days a year, Florida is adding $805,000 of wealth into Florida, 24 hours a day. Again, that's just an amazing opportunity we have. But let me point out just two areas. One of the 6 pillars is what we call talent, supply, and education. And I'm only, just to save time today, I'm only giving you the statewide numbers. You could look at all 67 counties, and you can find out how your county is doing on these metrics as well. All you would do in the top right corner there is pull down the drop-down box and pick on the county that you're interested in. But to save time today, I'm only going to give you the statewide numbers. So here's a look at how our education, how our talent pool is shaping up. So you can see on third grade reading scores, as an example, Florida is improving, but only 54% of our third graders in Florida are reading at grade level. We have a goal by 2030 to get that to 100%, and that's going to bode well for our future talent pool. You can see we have almost a 78% high school graduation rate. The fact that that's green means that that's improving. It's heading in the right direction. So you kind of see how this works, and we pay attention. These numbers are updated monthly, and again, they're available for all 67 counties. If you happen to live in St. Johns County, as an example, your third graders, 77% of your third graders are reading at grade level. But if you happen to live in Lafayette County, only 30% of your third graders are reading at grade level. So it's nice to see the state averages. It's more important to know what's happening in your community so business leaders can actually help move the needle. And then finally, I want to talk a little bit about business climate and competitiveness. This has to do with costs of doing business in Florida. And I think the elephant in the room in Florida is we've been lowering costs. We've been lowering taxes. We've been lowering costs for 5 or 6 years now, but we've had a major workers' compensation setback. So on December 1, we had a 14.5% increase in workers' comp. That's a $1.5 billion increase on the backs of small businesses in Florida. And of all the southeastern states, Mississippi, Alabama, and Georgia have rates that are lower than ours. And so we really don't know yet what the impact is going to be. But the research we're doing with chamber members throughout Florida is that this has everyone's attention. Some people are telling us they're going to slow down on hiring. They're going to take a look at whether or not the legislature is going to fix this when they come back. So stay tuned. We're paying very close attention to that. We actually have a massive workers' comp task force that's already come up with solutions that we're working with the legislature on. Hopefully the legislature will have the courage to put business ahead of trial lawyers as we move forward. So I wanted to start this call off by, again, thanking Doug Davidson for his sponsorship. I also wanted to give you a quick 30,000-foot view of what's happening with our economics, our demographics, and our politics. And it's now my pleasure to introduce my colleague, the Chamber's chief economist. Dr. Parrish not only serves as the Florida Chamber Foundation's chief economist, but he's also the director of research. The Florida Chamber remains the only state chamber in America to have a full-time chief economist, and we do that because we think that Florida is actually setting an example for the rest of the nation to follow, and part of that rationale is that we have to lead in important policy areas in economic development, and so that's why we have Dr. Parrish here. So, Dr. Parrish, why don't you take it away and move us in to where we go from here.
Thank you, Mark, and thanks everyone who's on the call today. I want to do four things today. I want to talk about Florida's current economy and where the jobs and what type of jobs are being created. I also want to go over my last couple of years' forecasts, a little bit about how job numbers get revised, something that's a pretty interesting little process, and then I'll do my forecast for 2017 for Florida. Before I get started here, I do want to let everyone know that our Small Business Index survey is out in the field. I know it just got resent within the last hour or so. And I want to encourage you, if you're a small business owner, please take a few minutes to respond to that thing. And, you know, we use that, the Chamber uses that for their policy formulations, but also I use it, and there's 4 specific things that I look at from our small business survey. I really look at our plans for our businesses, for their plans for capital investment, their plans for hiring, their look at which direction the economy is going and which direction the state is going as far as being helpful or not to business. So I encourage you to please send that in. I appreciate those of you that do and take the time to do that. Now I want to take a look at, Mark showed this. This is on the front page of the Florida scorecard. Over the past 12 months, Florida job creators have increased our job number by 253,300. Our unemployment rate is up a little bit, but that's just actually signs of hope that people that may have been out of the workforce jumping back in looking for a job, because there's actually good probabilities that they'll get one. So that's something we're looking at. We always track on the scorecard. Another thing is most people don't know this unless they listen to us on a regular basis. That 1 out of every 10 jobs in the U.S. is not just happening right now. That's really been happening since the early part of 2014. And, that's pretty phenomenal. We've got about 6.2% of the population and about 5% of the U.S. economy here. And to continually, over almost 3-year period, produce basically double the weight of what our state should be producing in jobs. That's really a testament of how friendly Florida has been, in the last few years to attracting private capital. And as we know, private capital puts Floridians to work. let's show where the jobs have been created over the last year. This is our metropolitan statistical areas over the past 12 months. This is the numbers as well as the percentage increase, and also the heat map. It is a heat map on percentage increase. Where you see the darker green areas, you see the highest percentage increase. Take a look especially at that Orlando up through the northeast to Jacksonville. We've got a lot of dark green areas. And we've actually got some areas that are negative in Florida that, certainly are a concern. What we've learned over the last few years is the majority of the job formation is happening in the metropolitan areas, and some of our rural counties are experiencing either near zero or in some cases negative growth, and that's something that we're watching with concern. I want to look now over the past 4 years. This is something we don't do often, but a year-on-year look is important. But I wanted to take a look back about the last 4 years of where the jobs are created. Same type of heat map here. You can see where the dark green areas are producing the highest percentage increases. I'll show you a slide here in a second where I separate them and compare them to the U.S. rate. But take a look at your area. You'll be able to see how you've fared over the past 4 years. And I'll go ahead and tell you that the U.S. rate over the last 4 years has been 7.5% job increase. So those of you in areas that are showing above a 7.5%, certainly you're growing faster than the nation as a whole. Note down there on the bottom right-hand corner, the Miami, Fort Lauderdale, Palm Beach, MSA is the 3 counties down there. Just so those of you that are on the call that are from that area, I want you to be able to see what your area is. I split them up by county so you can see. Palm Beach certainly is the fastest growing, with Broward not far behind. Miami-Dade actually at 6%. This is over the last 4 years, so more or less about 1.5% a year. Even lower than the U.S. rate, which is running now about 1.7%. This slide is the one that shows your MSA in order, and there you see in the orange bar in the middle the U.S. average. You might note there we only have one metropolitan statistical area that has been negative over the last 4 years, and that's the Homosassa Springs. And for those of you that don't have your translator between counties and metropolitan statistical areas, that is Citrus County, just so you know. But I want to show you where the jobs are being created and what categories they're coming in. This slide has a lot of information on it. Take a look at the first column there. Employment now means, as of the last tick on the jobs report, this is how many people are in each one of these categories. This is not every single category. There's a miscellaneous and information, a couple of small ones in there. But I do want to show you, kind of give you some sense about which ones are growing. These are actually ordered in percentage growth over the past 4 years. And you can see the clear winner is construction. 33% job growth over the last 4 years. That's nearly 115,000 jobs in that category. Those jobs carry a lot of weight because not only are they jobs now, they're typically building projects that people will work in and that will put people to work. So that's a really good sign for the next few years of our economy. Professional and business services has been the number 1 job creator over the past 4 years, just like it has been over the last 12 months. 210,000 jobs. That bodes well for Florida business as well. I think one of the surprising things to me, and I think a lot of people, is the manufacturing category, though. You can see in there that we got about 360,000 manufacturing jobs. I can easily remember when it was about to break below 300,000 in the state of Florida. That's about the time when everyone said manufacturing in the United States is dead. 13.4% is no small number over the past 4 years. And what's interesting is, those manufacturing jobs, they have the highest job multiplier of any job. And what they also have is, they diversify the economy, they produce high-wage jobs, they improve our balance of payments. They also address one of the biggest issues in Florida, which was identified in our trade and logistics study, is that so much freight leaves this state empty. The more we can put in empty containers and empty ships and ship them out of state, stuff that we manufacture here, not only is it good for Florida and creates jobs and all that stuff, it actually will reduce our inbound freight costs, and improve our cost of living here, not just for business, but also for Florida families. So I'm really excited about this, but I want to show you how big a deal this really is for manufacturing. What I've plotted here is the U.S. versus the Florida manufacturing job growth rate. This is spectacular. What you can see is the Florida in blue. Not only is Florida's job increase, positive, it's actually accelerating. And what you can see with the U.S. is it peaked, the recent peak has been 2014, has been declining, and will probably be negative by the end of this year. So Florida is growing manufacturing jobs. One of the big things I think happened was this is due to the repeal of the manufacturing machinery and equipment sales tax and making that repeal permanent. That's something that the Florida Chamber led the way on. Certainly that's helping us diversify our economy here and produce some high-wage jobs and counter the trend that's actually happening in the U.S. right now. Now I want to talk about Florida's economic forecast. There are several things I'll look at here. I told you I'll look at, the small business survey. We look at international growth rates, bond rates, whether the recovery is long in the tooth or not, change in the outlook, energy price volatility, legislative uncertainty is one of the big things that I'm looking at right now. I won't go into details about this because we have Dr. Foster and we have John Coates also. We'll talk about some of these things in detail. But also on this list, you're going to have to add right now workers' comp, overtime rules, those things that are going on in the state. Trust me, those things matter. I want to stop, make a little pit stop here and talk about year-end job revisions because when I talk about the forecast, I not only have to forecast with incomplete information by the end of the year, then every March we come and get a revision. This is the forecast that they did in March 2015 to the 2014 jobs numbers. They came back and added 49,000 jobs to that. So that was about a 20% bump. And then I'm going to show you what they did to the next year as well. This is side by side the last 2 years. So we had another bump. They actually reduced 2014, bumped up 2015 by 24,100. So what we're doing here when we forecast, to be clear, is we've only got job numbers through October. We don't have November. We don't have December. And then we don't have the revision. So what I did when I forecast the year before, the year into 2014, I thought the number was 233,000. I forecast 250. When they did the revision, they revised it up to 257.9, which was awesome. They revised it much closer than my number, and I was only off by about 3%, which if you can hit this number by 10%, you walk away and congratulate yourself and go on. So I'm hoping to do that as well this time. When I did the 2016 forecast, I forecast 300,000 net new residents. I think I'm going to be a little low there. And I forecast 200,000 net new jobs. I forecasted the order of them as well. And I'll show you in a second how I came out. I really believe we're going to end the year after the revision at about 220 to 230,000 jobs. So I under forecast for the 2016 year. Certainly things didn't happen as poorly internationally as what I had expected them to. And Florida businesses kept investing in capital equipment. And that was a really good thing. And so once again, we created more than 1 out of every 10 jobs in the country last year. Here's my update on how I did, versus the forecast so far. I forecast all but the trade, transportation, utilities. For me, that was my big miss. I forecast it being the number 2 growth area for the state. I certainly expected some more things kicking in with, the Panama Canal opening. We got a deep water port in Miami that's going to produce more jobs here in the state. It came on a little slower than expected, so other than the fact that I got trade, transportation, utilities number 2nd instead of 4, which it ended up being, I hit that. I also forecast the number 1 growth category, which was construction, and I certainly got that right. One of the interesting things is trade, transportation, utilities has actually been nationwide the biggest job growth area for 2016 once we got the 2016 quarter 2 results in. So I would like maybe to say that maybe I'm not wrong. Maybe I'm just early on that call as well. I want to talk now about the forecast that I'm doing for 2016. Now, I want to tell you a couple things about when I got ready for this forecast. I look at it as there's a distribution function of what the forecast is, and I calculate that. The last couple have been pretty symmetrical. I've been able to cover about 80% of the probability with about 20,000 jobs each way. So 10% either way, fairly symmetrical jobs distribution. However, that's actually not going to happen this year. And I think the point was driven home while I was finishing my slides yesterday. I saw an article and a little video on CNBC yesterday. They had Bank of America's equity strategist, Savita Subramanian, got on there, and her forecast was for the S&P, which is about 2,300 or so, 2,300 right now. Her forecast for next year ranged from 1,600 to 2,700. And I think that's a really good representation of the raw amount of uncertainty coming up for this year. And certainly we don't know what's going to happen. We really need all 3 things to line up here: the world economy, Washington, and our new incoming president, as well as the Florida legislature to line up, promoting private investment in the state of Florida. And if they will, certainly we expect to have a big year. But now the forecast, I want to show you what that is. Here's what I came up with. This is my probability distribution. It's my own forecast here for jobs in Florida next year. And I like to use probability distribution functions because of, hey, it's an uncertain business. And like I said, this year is more certain than others. So my forecast, to be clear, is 190,000 jobs next year for the state of Florida. It could go a lot higher and even a lot higher than this year. If we get Washington and everybody to line up and we get confidence that businesses will invest in our state and invest in this country, we may have repatriation of some profits that are overseas. There's all kind of options here. So notice the right tail is a lot wider than the left tail of this distribution. To cover 80% probability, like I said, a normal year, about 40,000 jobs will cover that. This year it takes 70,000 jobs to cover that 80% in the distribution here, so in my forecast. So once again, more uncertainty. We're all hoping for the best. We have businesses here talking about, things will be good and they'll invest. However, we have a lot of rattling going on, with the legislature and other things, sending signals that may not be so positive for investing in Florida. So anyway, I hope that it's going to fall in that distribution somewhere and near the middle, where there's 50% probability above and 50% below, and that's the 190,000 jobs. Not a lot different than what we're having here. Certainly a little lower, but a lot of it's due to labor market tightness. It's getting a little harder and harder to find people right now in the state. So here's my overall forecast. We've got 330,000 new residents. That's about 920 net new people a day. I think it'll come down a little bit from the 190,000 net new jobs. And here's the categories that I think will continue to be to be big. Number one there, professional and business services. Number two, education and health services. About 90% of that is health care. That's what we've seen over the past few years, and that's actually, I think that trend's going to continue. Leisure and hospitality will stay near the top unless we have some serious reduction in tourism marketing, and then certainly I would want to change my forecast due to that. Trade and transportation and logistics, certainly number two in the country right now as far as job production, should be in Florida as well. They're quite a few jobs behind some of the other categories. So number three or number four, I've got them number four, I think, and I look forward to the revisions, and I look forward to seeing what they come out with. But anyway, that's my forecast. I certainly appreciate everybody listening. Instead of taking questions right now, I'll take mine when we have the open question period at the end of the call. Right now, I want to introduce Dr. J.D. Foster. He's the Vice President of the Economic Policy Division and Chief Economist for the U.S. Chamber of Commerce. Dr. Foster previously was Chief Economist of the Tax Foundation. He was at the U.S. Department of Treasury. He's been at the Office of Management and Budget, and then he was a Senior Fellow at the Heritage Foundation before he found his way to the U.S. Chamber of Commerce. He actually got his Ph.D. in economics from Georgetown University. I know for a fact that's a tough place to get a degree from, so I appreciate that. I had the chance to visit with Dr. Foster in May during the Chamber's fly-in and when I briefed the Florida congressional delegation. We really had some interesting discussions, what each of us were watching around the world and for the U.S. economy, and I know it'll be interesting. Dr. Foster, welcome to our webinar.
Well, thank you very much. It's great to be with you. It's good to be with you in a disembodied fashion in any fashion way. I must have enjoyed listening to Jerry Parrish give his economic forecast. I think it's a lot of sound reasoning there. I want to talk a little bit about the U.S. Economy, the economic outlook, and I think you have to start in looking forward with looking at where you've been. And where we've been is an economy that has been growing steadily, slowly. We've been struggling for new words to describe it because it's been so consistently anemic, but it has been growing. The example I use, the analogy, is of a student. You've got the best student in the school, but they're turning in C grades year after year after year. Now, the good news is Johnny's going to graduate from high school turning in C grades. The bad news is there's an awful lot of potential there that wasn't being met. We could have done so much better than we did and have done and are doing right now. But we have grown. And so it's sort of a half warm, half cold situation in the economy for the last few years. Then we come into 2016, and in the first half of the year, the economy slowed markedly. The growth rate dropped to about half of what it had been. So if you want to continue the student analogy, our C student suddenly was turning in Ds. And that was very concerning. There wasn't any obvious reason for that in the overall economy other than the cumulative effects of what the administration, through regulatory policy and otherwise, was doing to business optimism. And then we had, of course, in the third quarter, we had a nice little pop in GDP. But when you look at the numbers, it turned out a great deal of that extra growth from the previous half for the year, a lot of that extra growth was in inventories and the odd situation where the soybean crop in Brazil turned out to be quite poor. So we ended up exporting a lot more soybeans to China than we normally would. It's great that we did that, but that's not the kind of growth you can build on year after year. We expect the rest of this year to come in so that the overall year is about 1.5, and that's what we carry into next year. And if nothing else changed in terms of policy, then we would probably be looking at something in the 1.5 to 2% growth rate for next year, maybe a little bit more higher, more towards what we've had since the recovery began. But certainly nothing to write home about, just good, steady, plodding growth. And that's if nothing had happened. But we do have to worry about something, and that is this recovery is kind of long in the tooth. We are now well in past the average of the post-war duration for an economic recovery and expansion. And we have not repealed the business cycle. So we know that somewhere in the calendar, a year, 2, 3 years, somewhere out in the future, is a recession. We just know that there isn't any sign of it now. There's no obvious buildup in the economy, no obvious imbalances that would suggest that something's about to go wrong in the domestic economy that would trigger a recession. That's the good news. Now, once we have that going forward, we now have to say, okay, well, what does the election of Donald J. Trump do to that kind of a forecast? And it's not entirely clear. There's an awful lot of uncertainty around it. You have a president who could be described as an agent of chaos when it comes to public policy. And I don't mean that in a negative way. That's the way he ran his campaign, and the man won. Give credit where credit is due. But now I'm trying to make sense out of it as a policy issue, and I'm trying to make sense of it in terms of what that policy would mean for the economy. And I have a president who's tweeting attacks at a union boss, who's attacking one of America's top companies in Boeing, and who did a deal to save jobs in Indianapolis with Carrier. Not conventional behavior. So that gets back to, I have a very unconventional president here. I have an unconventional president who's slowly filling out his government and leadership positions, where you have named the head of the Small Business Administration before you've named your Secretary of State. Not exactly standard operating procedure when it comes to presidential transitions. There's a long explanation, I think, for why it's turning out the way it is, but the fact is there's an awful lot of positions that aren't filled yet. He appears to be focusing in part on national security positions, which is great. But if I'm looking at an economic forecast, I want to know who the Treasury Secretary is. Good, check that box. I want to know who's going to be running the National Economic Council. I have no idea. I want to know who's going to be the OMB director. I have no idea. I want to know who's going to be the CEA chairman. I have no idea, and on and on and on. So I'm trying to make sense out of the economic policy consequences of this incoming president, and none of the people who would be in the process of formulating and further developing the policies that Trump ran on, they're not there yet. And so it's very hard to make much sense out of how that would all play out. Donald Trump ran for president on a policy-light platform. He had some tariffs, and he had some trade commentary, and talked about a wall, and he's got a tax reform plan that's kind of fanciful. It gives you a sense of direction, but there's not enough detail there that you can make much use of. And so you've got a policy-light campaign platform. Again, not a criticism. The man won. But I'm trying to make sense out of all of this for saying, okay, well, what does that mean for the economy going forward? And it's not entirely clear. I've got some international risks, and your next speaker is going to talk about those, so I won't elaborate on those. But when I'm looking at the consequences for the U.S. economy, I'm looking at the fact that Italy is going to go through some more trouble, and that means I have to question the survivability of the euro. Maybe it'll continue for a while. I think with the German election next year, it probably will. But the fundamental problems with the euro persist. I have a Chinese economy that's terribly important in the global economy, but I'm not sure really how healthy it is. The Chinese keep pouring more and more stimulus into the economy. Well, if your economy is really strong, why are you putting so much stimulus into it? Suggests there's a bigger problem there. And then we have a U.S. monetary policy that's diverging from that of the other major central banks in the world. And at the very least, that tells me I have an issue with dollar appreciation going forward. So I have these international concerns. I have concerns about the president's policies and what he's really going to do. There are hopeful aspects to this. In fact, on balance, talking about uncertainties, I can list off a number of things to be concerned about. The lack of specificity in policy, the lack of presidential appointments, some of the things he's talked about in trade, but I think there's a hopeful view of that, which I think he is looking at making the U.S. such a great place to do business in that we don't have to worry about things like tariffs and companies leaving. We're going to make the United States too great a place that everyone's going to want to come here. And I think that's his basic point of view. It just doesn't always get expressed that way. So I have these risks, but on balance, I would say we have more upside risk than down. There are some things he can do right off the bat that will help the economy. For one thing, There's a number of executive orders he can reverse. There are regulations he can reverse quickly. There are others which he can reverse working with the Congress very quickly. At the very least, he can stop the outpouring of regulations, which I think is one of the main reasons the economy has done so poorly. For a period of time, if nothing else goes right, you're going to have an extended period where the government is not going to be piling on more regulations, slowing the economy down further, creating more disruption. If nothing else, that will add significantly to economic growth going forward. How much is significantly? No one should ever put a number to that. But it means that the upside risk relative to that baseline forecast is much stronger. And then going forward, there's a lot of areas in policy where he can add to the gains from the executive orders and the slowing of the regulations. Things like tax reform. Tax reform is probably a more viable issue right now than it has been in 20 or 30 years. There's no certainty as to outcome, no certainty as to progress, no certainty as to timeline, but there is a broad understanding that tax rates have to come down. And that's a good start. There's a broad understanding our international tax system is out of whack with the global economy. We are completely out of sync with all of our major trading partners and how we treat our companies operating overseas. So there's a lot of good to work with there, but again, it's not very well specified. We do have a fairly detailed blueprint. It's not a plan, but it is a good blueprint out of the House Ways and Means Committee that Speaker Ryan has embraced. So that's a good starting point, and if the incoming president says that's my starting point, we can start moving this thing forward, and that could significantly add to long-term economic growth. That would be really beneficial. Another one is infrastructure. President-elect has talked a lot about infrastructure spending. They're very popular in Washington. They throw around a lot of big numbers. Don't pay any attention to the big numbers because they don't really matter until you start talking about how you're going to finance this. And what is the time frame and how you're going to legislate it? What is the structure, federal versus state? The point is not the detail. The point is we have a dearth of infrastructure spending in this country, and there is a pretty strong agreement between the Congress and the President on a bipartisan basis that this is something we have to address, and if we do, that will have tremendous long-term benefits to the economy. This isn't a short-term stimulus. Infrastructure is not short-term stimulus, but it can make a tremendous difference to the economy in the long run by reducing cost, reducing transportation cost, and improving efficiencies in transportation. Even in trade, that the President-elect talks so much about, all the terrible trade deals we've negotiated according to President-elect Trump, most specifically NAFTA. Well, NAFTA is 25 years old. It was negotiated in a different era. Mexico and Canada have both expressed an interest in saying, okay, well, if you want to rewrite it, what does that mean? What do you want it to look like? There's a chance to end up with a much better agreement, if for no other reason that the old one is 25 years old, and we've learned a few things since then, and the economy has evolved quite a bit since then. So even there, it may sound overly optimistic, but the reality is there is a chance. There is an opportunity here to take something that seemed very threatening in the area of trade and turn it into a real positive. And I think the President-elect is going to be interested in that. We have to negotiate an agreement with the UK. How does that fit into this arrangement? So there's a lot of potential for positive. None of it may turn out. This is still Washington, D.C. We have a President-elect with, one might say, a passing familiarity with one political party, the one he ran with, and then he has an opposition party. He's going to have to figure out how to make this all work, and he's not going to run the White House the way previous presidents since Ronald Reagan have run the White House. This is going to be different, and we're all going to have to learn how to adapt. At the Chamber, we are committed to working with the new administration to make these good things that can happen that will improve the economy going forward. We are committed to making that happen and working with the administration. But even my office, I'm looking outside my window. My window's looking at the White House. I'm looking at the north face of the White House, and I'm asking myself, how is this man going to run this building? How is this man going to run his administration? How do I pull that into how policy is going to evolve and what that means for the economy? Right now, what we have is a lot of question marks, some downside risk, but also significant upside risk. And I think on balance, there's more upside than downside, and that's not just a matter of optimism. There is so much opportunity to correct what has gone wrong for the last 8 years in economic policy. It is a target-rich environment, and we just have to see if the Congress and the administration can work together to make some of those things happen. So with that, let me wind up my portion, and as Jerry did, turn over to any questions at the end.
Thanks, Dr. Foster. I appreciate that. I'll play Ivy here in a minute. She's facilitating our call, and say if you want to ask a question, hit *1, and we'll patch them in just a second. But before we get to the question, we actually asked our members to send in questions in advance, and I've got a question here for you. As other people get in the queue to ask questions, and keep in mind, Dr. Foster, I know, has a hard deadline. He has to leave at 1 o'clock for another event. So thanks for staying on here for a couple of more minutes for questions. But you mentioned regulatory costs, Dr. Foster, and that one thing they could do is just quit adding on to them. But our president-elect has made some pretty bold statements about regulatory costs of existing regulations. What can he really do, and what do you think he can really get past up there that would help roll back some of these heavy burdens that our business community is facing?
Well, it goes in levels. The first level, obviously, is that the current administration has recently passed and is trying to ram through a lot of new regulation. Congress passed a rule. It's called the Congressional Review Act, which stipulates that the Congress can go back and tell the regulatory agency no. They can take that regulation, circumvent the normal regulatory process, and simply veto, in effect, the regulation that the regulators are currently today trying to push through. And there's a lot of people are putting together very long lists of things that would be subject to the CRA and that ought to be included in those sorts of deliberations. So the things that are currently in the pipeline, there's a great opportunity to stop. Obviously, things that the administration doesn't quite get out the door, the incoming administration can just tell everyone, okay, stop where you are. We're not putting anything out for a while. And some of these things ultimately may turn out to be needed because there's a statute that requires a regulation. But for the immediate future, he can stop what's going out the door. From that point forward, he can reverse, working with the Congress, things that have passed recently. He can adjust the way regulations are enforced at the agency level, and then we will have to begin the process of reigniting the regulatory process itself and issuing new regulations. And that is going to be a more drawn-out process. That's something that's going to take some time, because whether you put out a regulation for the first time, you rewrite it, or you try to reverse what was done, there are legal procedures you have to find, and they take time. But a lot of what has happened can be reversed fairly quickly. And most importantly, as we think about these regulations that you might want to reverse, something that passed, say, a year or two ago, oftentimes these regulations have enormous upfront costs. We've already suffered those costs. So now we have to ask ourselves, going forward, are the ongoing costs so onerous relative to the benefits that we can write a new regulation that won't have upfront costs that will make it worth repealing? It becomes a much more complicated question. Dealing with stuff in the pipeline, dealing with the recently enacted regulations, those can be addressed fairly directly.
All right, thank you for that. And I've just gotten a question. They don't want to talk out loud, but they did email me a question here. This one is actually something similar to what you and I talked about. It says, what are the biggest risks to the economy today? And I think the way I posed it to you when we talked in May was, what keeps you up at night? Not necessarily the economic stuff, maybe more toward the political end, because I know John Coates is going to talk some about the economic stuff. But what really keeps you up at night as as a threat to the positive movements in the U.S. economy? What are you looking at now?
Well, I guess there's three things I can tick off very quickly. One, that interest rates remain incredibly low, and that's distorting the allocation of capital on a global basis. And if and when interest rates go back to normal levels, we're going to find an awful lot of mispricing of assets, and that's going to be very painful to correct. The second is when interest rates rise, as they have recently in the U.S., that's going to create tremendous exchange rate pressures. there are normal trade issues that arise from that. We all know what they are. It's harder to export, import, harder to compete with imports. I'm more worried about the fact that a lot of emerging market debt is denominated in dollars, and if the dollar starts rising, that debt becomes extremely expensive. And the third one, which is more at home, there are 2 open seats on the Federal Reserve Board. President Trump's going to nominate people to fill those 2 seats. Janet Yellen's term at the end as chairman expires in 2018, very early. Whoever the president-elect nominates to fill those Fed chairs this year, one of those 2 people is likely going to be the next chair. The market's going to be looking very carefully to make sure that at least one of these 2 people is someone who credibly can become the successor to Janet Yellen. And that's one where we just don't know what the president-elect is thinking. There are a lot of good people out there. There would be good choices, and it would calm the markets, and we'd be fairly confident of the course of monetary policy. But there are an awful lot of people who want those positions who probably shouldn't be there. And until that gets clarified, I think that's going to be a concern for the markets.
All right. Well, thank you so much for your time today, Dr. Foster. It's nice to hear something from a Washington perspective and from somebody who looks at these things from all the angles that you do. I want to thank you once again from the Florida Chamber and the Florida Chamber Foundation for participating with us today. Thank you very much.
Thank you all. Have a great day.
All right, now I'm pleased to introduce our next speaker. His name is John Coates. John is the relationship manager at PNC Capital Advisors. He's got over 20 years of investment industry experience, and prior to his joining PNC, he was a portfolio manager with Franklin Templeton Investments, where he managed global equity and global fixed income portfolios. Now, I've asked John to concentrate on some of the international things that are going on, as well as some other things that are very important to Florida's economy. John, welcome to the call, and thanks for lending your expertise to us.
Thank you, Jerry. Good afternoon, everyone. Thank you for taking the time out of your busy day to hear from us. And while I'm going to have an international spin on my discussions, it seems like what's been going on in the U.S., it seems to be the dog that's wagging the tail at this over the last few weeks. So I'm going to be interweaving some U.S. points as well. I prepared a presentation here to review some of the global economic and investment highlights, but I look forward to the question and answer period, as it will enable me to focus discussion points of high concern to you. Please turn to the agenda page. Over the next 15 minutes or so, I will provide a brief economic review of the global economy, discuss the recent trends in the U.S. dollar and global government bond yields, review recent survey results by PNC's banking division on small and mid-sized companies based in Florida, as well as highlight some recent financial market performance, and then wrap it up with PNC's outlook on the U.S. economy and financial markets. Turning to the economic review, in the U.S., as I'm sure you all have seen, there's been a significant improvement in economic and investor sentiment following the Trump victory. To add to that momentum, third quarter GDP was revised higher at 3.2%. It was somewhat surprising result after a weak growth in the first half of this year. Business and consumer confidence continues to point to solid growth in the fourth quarter, as the stock market, narrowing credit spreads, and rising loan growth are all supportive for further economic expansion. In Europe, the rise of populism is a global event. Notable reactions have occurred in the UK with the Brexit vote to leave the EU, the U.S. presidential election, and most recently, the Italian referendum, which failed with a resounding 59% against. Some potential implications of the Italian referendum failure include the opposition parties throughout the EU gaining support, such as the Five Star Movement in Italy, National Front in France, and the Alternative for Germany Party in Germany. It increases the likelihood of an Italian exit from the EU. It casts doubts on Italy's ability to make the changes needed to reduce its debt and stimulate its economy. And it makes investors more wary of investing in Italy and the EU for that matter. Up-and-coming events that could further add to economic and financial market volatility include the presidential elections in France and Germany next year. Now, while economic conditions and sentiment are not as strong in Europe as they are in the U.S., they are, however, not as bad as you may think. Economic indicators point to continued positive growth, but at a more tepid pace. For example, EU and UK purchasing manager indices strengthened to over 53. A measure over 50 is considered expansionary. Eurozone growth has accelerated to an 11th-month high in November. The European Central Bank will continue with quantitative easing measures, and as expected, the ECB today announced an extension of their bond buying program out to December 2017. It was scheduled to end in March next year. To generate faster and more sustainable growth for the Union, member countries must agree to greater cohesion on fiscal policy and labor market reforms. In Asia, the slowdown in the Chinese economy had put significant downward pressure on world growth over the past few years, especially among commodity-oriented countries. Following recent fiscal spending measures, the economy appears to have stabilized. Recent yuan depreciation should help to increase exports, providing additional stimulus to the economy. Japan's central bank shifted focus from a negative interest rate policy to a zero interest rate policy, as concerns have mounted over the efficacy of negative rates, or the efficacy that negative rates could be economically stimulative. For more specifics on the U.S. economy, please turn to page 4. Looking at the consumer, the new smarter consumer has been a key driver of economic activity. Consumers have become more disciplined with their spending and use of leverage. The consumer debt service ratio is at its lowest level since the 1980s. Income and spending growth rates have stabilized at around 2.7% for the last few quarters. Rising employment and wage gains have strengthened consumer confidence, which stands at just over 107 and is approaching the 2007 level of 112. As for housing, rising income and job participation rates have helped to push home sales to a current rate of about 5.6 million units per month and are expected to continue to grow at a steady clip. Due to a lack of construction following the housing crisis, the relatively low inventory level of 2.2 million units should help to support prices. Despite the recent move up in interest rates, housing affordability remains attractive and well above the levels seen in the early 2000s. Now, specific to Florida, there does remain a relatively high level of foreclosure inventory. However, the relatively lengthy legal process should mitigate a large wave of homes coming to the market at any one time. Now, lastly, on capital expenditures, capital investment has continued to be a drag as corporations have been focused on dividends, share buybacks, and merger and acquisition activity instead of reinvesting in their own businesses. Despite a 4.8% surge in October goods orders, overall orders have been dragged on the U.S. economy for the last 2 years. With a new administration focused on greater infrastructure spending, tax reform, and foreign profit repatriation, this could be a catalyst to get businesses spending again. Now, regarding 2 key emerging market economies, please turn to page 5. The Brazilian economy has suffered from the decline in commodity demand since 2011. Confidence in the economy and stock market were rattled by the Petrobras and presidential scandals over the last 2 years. However, following a pickup in economic data and commodity prices and President Rousseff's impeachment earlier this year, leading economic indicators have improved, pointing toward positive economic growth by early next year. Now, while inflation continues to run high at about 6.65%, it has come down following rate hikes by the central bank and a 25% rebound in the currency. However, concerns over trade restrictions by the U.S. and rising U.S. interest rates have put downward pressure on the currency recently. With regard to China, the market has been overly concerned with the decline in its GDP over the past few years, from low double digits to now sub-7% growth. As the second largest economy, it was inevitable that a slowdown would occur following a drastic rise over the last 25 years. Following recent stimulus measures, the economy appears to have avoided the hard landing scenario many skeptics and the media were calling for last year. While there are still some medium-term concerns, as J.D. alluded to earlier, from rising debt levels and the real estate market, it appears the country is seeing some success on its plan to transition from a fixed asset investment economy to one driven by consumer consumption. Consumption as a percentage of GDP stabilized at about 35% and has risen slightly over the last few years. However, one must keep in mind that it will take decades to achieve the level of consumption as a percent of GDP seen in the U.S. or Japan. Turning to the next page, there has been a significant rise in the U.S. dollar versus most currencies over the past few weeks and months. The charts here, I have indexed the currencies as of June 30th. While the British pound weakened following the referendum vote to leave the EU, most of the dollar strength this year has come after the U.S. election, as prospects for higher economic growth have developed along with rising interest rates. Investors have shifted investments toward U.S. dollar-denominated assets. The largest appreciation has been against the Japanese yen and the Mexican peso, both at about 11%. As prospects for the Japanese economy have improved, safe haven flows have been unwinding since the election as investors seek higher growth investments. The Mexican peso, on the other hand, has suffered from Mr. Trump's comments over trade barriers, which would significantly impact the Mexican economy. The rising dollar is one of the key headwinds facing U.S. corporate profitability. We expect the dollar to continue to strengthen further. However, most of the appreciation has already occurred. On page 7, paints a similar picture on interest rates. The majority of global bond markets have seen a rise in their respective interest rates this year. Initially, this was due to improving economic data following the summer lull, which in turn saw a reduction in investor risk aversion. Inflationary pressures have also been building over the past few months, with commodity prices rising, increasing wages and employment in the U.S., and recently from the proposed fiscal policies of Mr. Trump. Increased deficit spending on infrastructure and defense, along with trade modification, are seen as inflationary. Rising inflation expectations have also caused rates in Germany and Japan to rise. And as I referenced earlier, the Bank of Japan, their shift to targeting a zero interest rate policy has also contributed to the rise in bond yields in that market. While Brazil's and Mexico's bond markets have done well for most of the year, they have recently traded off in reaction to Mr. Trump's comments on trade and risk from their weakening currencies, as this causes their debt servicing costs to rise. J.D. referenced that earlier, the level of dollar-denominated debt in emerging markets. It's currently running at about $3.3 trillion for emerging markets. Total non-U.S. Domestically oriented debt, so dollar debt denominated outside the U.S. is running about $9.7 trillion. So emerging markets have about a third of outstanding U.S. dollar debt not issued by U.S. entities. And switching on to the next page for some perspective on the Florida economy, please turn to page 8. All right, I'll just speak to the survey results. Every 6 months, PNC's banking division conducts a survey of small and medium-sized businesses based in Florida. The latest results came out in October, and they still point to businesses remaining upbeat about the local economy, as fuel prices and nationwide consumer income growth will boost tourism. However, a strong dollar and weak international economy will weigh on international tourism and trade. Strong population growth will support home construction, yet a large foreclosure pipeline may dampen home price appreciation. While business owners expect growth to decelerate somewhat from the prior projections, the overall outlook for growth remains solid. So while they are tapering sales and profit projections, they expect to increase hiring. In addition, 25% of the companies expect to increase capital expenditures, which was up from 19% in the spring survey. Now moving on to the financial market performance, the U.S. equity market has responded positively to the rhetoric coming out from the next administration, while interest rate-sensitive sectors have declined. The likely beneficiaries from the new administration are financials, industrials, and energy-related companies. These were the key drivers of performance in November for U.S. large-cap and small capitalization stocks. With the recent strength of the U.S. dollar versus nearly all currencies, international stocks declined. Fixed income sectors declined as interest rates rose due to rising inflationary expectations and a rotation from the safety of U.S. Treasuries. Municipal bonds also decline as the prospects for tax reform could make them relatively less attractive. If you wouldn't mind turning to page 10, or sorry, page 44 on your slide. Looking at the equity market fundamentals, in particular U.S. large cap stocks, valuations have risen significantly since 2010. As of November 30th, the price-earnings ratio multiple for the S&P 500 was 18.3 times. While markets tend to be forward-looking, sometimes it's worthwhile to use history as a guide. The chart on the right takes the historical PE ratio of the S&P 500 going back to 1928. By taking into consideration the historical valuation levels, the data looks at the level of total return an investor would have earned over a subsequent 10-year period based on the level of PE at the time of purchase. At 18.3 times, the theoretical average annual return for the next 10 years would be somewhere between 6 and 7%. This is a significant drop-off from the long-term median return of 10.8%. And as Mark pointed to earlier, the significant growth in the plus 65-year-old demographic for Florida, investments are a significant component for them, for their assets, and as well as their spending patterns. And so that's an issue that Florida, more so than other parts of the country, have to deal with, given our large retirement base that we have here, which could mitigate some spending on their part, just given the outlook for potential total returns from equity markets here in the U.S. To wrap up my segment, please turn to the following page for our economic and market outlook. In summary, the U.S. economy appears to be on solid footing. While we expect around 2% growth over the next year or so, there are a number of policy options that, as J.D. alluded to earlier, on the table that the new administration could take to boost GDP. For the near term, we do not expect a spike in inflation and will likely run about 1 to 2%. The consumer continues to be the main driver of growth as the economy nears full employment and wage gains materialize further. The missing link is CapEx, but there are signs that corporate spending may have bottomed. The biggest headwind facing both the national and Florida economies is the strengthening dollar, as this will curb exports as well as international tourism. With inflation likely to remain in check, interest rates are not expected to rise much further from here. We expect rates to remain range-bound over the next few quarters as foreign central banks continue with quantitative easing measures to keep interest rates low, which will drive investors to seek relatively higher yields in U.S. Treasuries. U.S. equity market performance has been driven by macro events, as earnings have essentially been flat for the last 3 years and negative for the past 5 quarters. Valuation multiples such as price to earnings, price to book, and price to cash flow have all re-rated higher. In order to see material price appreciation from here, sales and profits will need to grow stronger. Now, the wild card is how much can the new administration deliver on its promises of greater fiscal spending and tax reform. We currently are in the latter part of the economic cycle. However, investor, corporate, and consumer sentiment have all picked up following the election, which could enable the cycle to extend further than originally expected. Thank you again, and let me turn it back over to Jerry to open up to the discussion to any questions you may have.
All right. Thanks, John. I've got a couple of questions that have been emailed that will get us started. But, Ivy, if you'll go ahead and make the announcement of how people can call in with a live question, and then I'll ask John one of the questions that's come in online.
Thank you. If you would like to ask a question over the phones, please press star followed by the number 1 on your telephone keypad. If you are using a speakerphone, please make sure that your mute function is turned off to allow your signal to reach our equipment. Once again, that is star followed by the number 1 to ask a question.
All right, I'll get started. Chris Carmody from Gray Robinson has sent in a question. John, I'll let you take this one. How will Italy's economy, and I suspect he's talking about the vote that just happened. We had a big resignation, got a lot of banking issues going on over there. How will that affect the U.S. dollar, and therefore, how will it affect Florida's tourism and construction economies?
Yeah, again, we're looking at now this. You will see the 64th government in 70 years now following Prime Minister Renzi's resignation. And as I mentioned earlier, this just creates greater instability in the region. The potential for populist parties, non-establishment parties to gain strength increases the likelihood of a potential European Union breakup. Now, market's been saying this for quite some time, since 2012, since the sovereign debt crisis over in Europe. And so what it does is it puts too much concern in investors' mind. So what you're seeing there is a flight to quality, flight to safety outside of the European Union into the U.S. So we've seen that already a little bit. So the dollar will continue to strengthen on the back of that. But Italy has been mired in a very low growth environment for a number of years. It seems like it's almost status quo, the continual change with governments. And so while it'll be positive for U.S. assets, U.S. dollar strength is somewhat negative, as I mentioned earlier, for U.S. companies, and especially for Florida, given our focus here on tourism, and especially international tourism. So you could see curbs in tourism coming out of European tourists. So that's a bit of a negative. As for construction, I think there's still sufficient demand coming in from internal relocations from other parts of the U.S. country. And so there is underlying demand there. We don't expect a significant pullback in construction, just given the increasing demand as more and more people come back to work, or increasing wages. The shift from rentals into single home ownership will continue, and plus the inventory levels are relatively low. So I think that should keep construction levels at pretty attractive levels from here.
All right, thanks, John. I've got another question here. This was sent in by John Hoy from Utilities Incorporated, and he was asking about the value of the dollar and how it impacts tourism, and then maybe any other effects that we haven't mentioned. I'll take the first part of that, John, and if you want to think about some other things that may be effects. One of the things that I look at when I look at Florida tourism, and we know our international visitors stay longer and spend more, and we love the tax yield and appreciate them coming over. One of the things I look at that the stronger U.S. dollar will also hurt it. It's not just the direct impact on people. It'll be more expensive for them to travel to Florida. Also look at our domestic visitors. We have a lot of folks come in, especially flying in the wintertime from Chicago and New York and Philadelphia and the bigger cities up north. You can track visitor volumes during and after blizzards up in the Northeast. It's a pretty good spike. People see a Visit Florida ad and they call their, go online and get an airline ticket to come down here because we're sitting there talking about it's 80 degrees in Florida. What's it doing in your part of the area? But we depend a lot. There's more than 90 million domestic visitors a year. And by domestic, I don't mean Floridians. I mean from other states. That's the only ones we count. So we've got not only maybe an effect those people from Chicago or New York or somewhere, they could go to some other country. Relative travel when the U.S. dollar is strong, makes it relatively less expensive for them to go to the UK or go to other places. So that's kind of a secondary effect of a strong U.S. dollar. And certainly there's some big spenders that come down here that, help leave us a lot of tax dollars. That can be a big effect. How about you, John? You got any other thoughts on that?
Yeah, looking at from outside the U.S., I mentioned it earlier, the rising dollar, given the level of dollar-denominated debt held by a number of foreign companies and foreign countries, is that it does increase their debt servicing as they have to pay more local currency to cover that same amount of interest payment or debt repayment. And so that has spillover effects into their business and their local economies, as now more money is flying outside of the country as opposed to going back into it. And it just becomes almost like a downward spiral as they start retrenching back, and all of a sudden they're not importing as many U.S. goods, or you're seeing potential layoffs and cutbacks in hiring, and so could affect tourism to another level. So that's where we see as the potential risk. So as I mentioned earlier, it's about $3.3 trillion in U.S. dollar-denominated debt that's held in emerging market countries. And so significant spikes do impact the local economies. A number of them have been suffering over the last few years. I ran some numbers before our meeting, or before the call, and just looking at the last 5 years, the dollar has been the top-performing currency globally. Some of the worst performers have been the Brazilian real. That's down nearly 47% over the last 5 years. Now, other ones include the euro. That's down about 19%. Same for the British pound. And the Canadian dollar, given its bias toward commodity-related exports, it's down about 22%. So it's going to be a drag for tourism, exports, and as well as what you end up seeing is that the consumer here starts to purchase cheaper goods abroad, and your trade balance starts to shift to more negative, which negatively impacts U.S. businesses there.
All right, thanks, John. And I think we got time for one more question here that just got sent in, and then I'll turn it over to Tony after you answer this one and let him close the meeting. Some of our members, one in particular, is interested in, says, given the rally in U.S. stocks, it seems that a lot of optimism has been priced into equities, and they're asking, is it too late to get in? You being a portfolio manager, you're uniquely qualified to answer this, John.
Yes, I agree. There does seem to be a lot of optimism built into the financial markets, especially equity markets. Just given some of the performance that we've seen, especially with U.S. small cap stocks following the election results. And it's very hard to say. There's plenty of impetus to say that the U.S. equity market could continue to rally. It really depends on what the first 100 days look like, what can get passed through. And J.D. referenced this earlier about regulatory reform, pullbacks of regulation could be that initial stimulus in the next year. With the Affordable Care Act getting repealed, there's taxes that are part of that will come off, and so you're potentially seeing 4 to 5% repeal in taxes that companies had been faced with in 2016 that they won't face in 2017. So there are some items at the margin that could keep or allow companies to see earnings growth to come through, which is what we need to see. Because at this point, the re-rating in the markets, as that chart showed you earlier, the historical price-earning ratio in the S&P 500, we're at the higher end of that long-term range, just looking plus or minus one standard deviation away from the median. And so at this point, to see meaningful returns, we need to see some earnings growth. And so is it too late? I think there's opportunities still to be had there. You have to be very selective. It does seem that you don't necessarily want to load the boat on longer duration fixed income, treasuries or high-grade corporate bonds. I think you need to be selective within equity markets, given the underperformance of many international stocks, including emerging markets, and as well as the weakening of their respective currencies. I think if you diversify out and not buy in too much of the hype, because the big risk in looking at it from a trader's perspective, it does feel it has been a buy the rumor. Now the question is on the other half of that saying is when do you sell the fact? And so results will need to come through in the next couple quarters in order for this recent rally to sustain itself. But it does feel like things are aligning themselves for the markets to do relatively well. But I would not expect high single, double-digit type total returns over the next couple years.
All right, thank you, John. Thanks once again for joining us today. To close out our webinar, I want to introduce Tony Carvajal, our Chamber Foundation Executive Vice President. He'll provide some closing remarks and discuss how we're going to use today's discussions in the Florida 2030 initiative. Hey, Tony.
Thank you all for participating in this. Jerry, thank you. Dr. Parrish, thank you so much for helping organize these forecasting. I'm going to take 3 minutes to go very quickly through 4 items. A quick review of what I've heard, providing my own forecast that on a buy order, planning for the future, and then I'm going to close with some dates that you probably want to have. So if you'll hang with me for 2.5 minutes, I'll make sure that we end on time. Mark Wilson started off talking about how Florida is changing and the evolving fundamentals in our economics and demographics are continuing to point favorably, but our future is fragile. So we got to continue to focus on building Florida's future. But I liked where he ended, talking about if Florida was a top stock, it's time to buy, continue buying. Dr. Parrish talked about the continued growth. And I heard a message that we're probably going to continue to exceed the U.S. You heard his projection of 190,000 jobs for the year. I know that this is a little slower than last year, but I think that he fairly said that the upside tail of that projection, if we align the world, Washington, and the Florida legislature, is there to be gained. And I'm hoping that if there's a time for you to be wrong, this is the time to be wrong, Jerry, and that we hit those high numbers. But clearly, we're going to need engagement by our members in this, and the business community has to stand up and make sure that their voice is heard throughout the year. Dr. Foster talked about the U.S. continuing maybe as a C or a D student, quite capable with lots of potential, but we're starting to reach that point where confidence is the real issue. I think the projection he left us with was about 1.5% growth rate. Key comments that I heard, no obvious imbalances, and there are a lot of hopeful elements. But chaos and the opportunity for chaos was really out there, and I think that was echoed by John Coates. Thank you, John, for your comments. Continued growth, if I'm not mistaken, I heard your target is somewhere around 2%. And the great point that you emphasize is the U.S. is not alone in the opportunities for chaos. I heard your message about Brazil, the EU, Italy, China, across the globe. But the most encouraging words to me was that the flight to quality is really going to bode well for Florida and the U.S. Actually, you said the U.S., I added Florida there. So here's my forecast, buy and assets, because this is going to be a wild ride over the year. Let me close with a few comments. The Florida 2030 project continues to go. Emily, if you will, move forward just one more. We are looking at the fundamentals of the state, assessing what we've got to get right over the next 20 or 30 years. While today we focused on the upcoming year, we need each of you to participate in planning for the long term. I'm looking forward to discussing this at our upcoming Capital Days, which is scheduled for March 22nd. A few dates before that I want to make sure that you have on your calendar, because you'll probably be interested in discussing the items that are going to come up at the Insurance Summit on February 1st, or some of the trade and international issues that will come up on February 14th and 15th. You can access these at the floridachamber.com events page. There are a number of different things that we'll send to you after this event, including links to where the slides are going to be posted and information on Florida 2030. Thank you so much for taking time today to participate in this economic forecast. We're always looking for your input and engagement. When we send you some details about this event, we'd love your feedback on what not only you heard on this event and what you'd like to hear going forward, but what other webinars like this we at the Foundation at the Florida Chamber should be providing for you. To all of you who presented today, thank you so much for the insights. We look forward to building Florida together. Thank you, and let's secure Florida's future. Ms. Ivy, I'll turn it back over to you.
Thank you, and this does conclude today's conference call. Thank you again for your participation, and have a wonderful day.